And welcome to our today's session. We are very happy to have a stellar lineup of speakers. Today, we will unpack how AI can help to account for climate risks. And for that, we will have people from very different industries coming together. A stellar lineup of speakers. Okay, we are just waiting for all the participants to join in, and we will start shortly. Just to remind you who you will hear from today, you will hear from MEP Eva Kaili, from the Commissioner Mairead McGuinness, from Professor George Skiadopoulos, from Dr. Kirsten Dunlop, from Dimitris Zafiris, Taifen Boperan, and from Mikolash Peksa. So as you can tell, we have quite a lot of speakers, and we will tackle the discussion from different points of view. So without further delay, we will start with MEP Eva Kaili, who has just joined us. As you know, she is very kindly hosting us today. We are very excited to be here. Eva, just as a quick reminder, is a member of the European Parliament, and she is also the chair of the STOA panel and the chair of the Delegation for Relations with the NATO Parliamentary Assembly. She is a member of Committee on Industry, Research and Energy, and she has been working on blockchain innovation and technology for a long, long time. So thank you so much, Eva, for having us with you today, and we look forward to hearing from you.
Thank you, Linda, for your very kind words, and thank you for your help. I am delighted actually to host such an important debate, and it's a real pleasure to have you as our moderator. I would also like, if I may at this point, to give a special thanks to EU40 for organizing this timely event, and to the STOA panel for having the patronage of it. As you know, I'm chairing Science and Technology panel since several years now, and we are always trying to understand emerging technologies, the impact they have, and also the potential that they have. It's very important also to have people like the EU40 that help you to give your message and better outreach, and also to involve young people, that they are the ones who will be affected the most. So I would also like to thank the fantastic lineup of speakers that are joining us online to discuss how digitalization and artificial intelligence can support sustainable finance, particularly by helping our financial system account for climate risks. This is something that is not taken under real consideration, but I just came back from a visit to Washington, DC, and it's really high on the agenda now, and as not expected maybe from both the Democratic Party but also the Republican Party. So the COP26 summit is delivering, I would say, a chilling but not surprising message that our current climate targets, they still fall short on what we need to deal with, and how do we decided to improve the climate crisis. Indeed, last week, the International Energy Agency noted that we would need to implement in full and on time all the climate pledges made to date to keep the rise in global temperature to 1.8 by the end of this century. And it's the first time, although we have high targets of sufficient ambition to hold global warming below 2 degrees. However, it's still insufficient to limit it to 1.5. And it misses basically the real goal of the Paris Agreement, and it also dramatically increases the climate impact. I would say that even if Europe is doing its best, it's not just Europe. This is a global initiative that needs to be taken in order to improve the numbers. And also, I experienced as a Greek the wildfires as a result of this climate crisis this summer. And I think this also underlines our inability to see beyond the present moment, and also our inability to take decisive action for our own future selves. However, technology offers us a glimpse of hope, and I think digitalization and artificial intelligence can help us to translate uncertainty into tangible risks that we can understand more easily, to be able to measure, to track, and also to tackle them. This is particularly important in the financial system. I think everybody has listened and heard about predictive AI that could mobilize also the resources of our economies and whatever they need to develop, but still it sends the wrong signals to investors and consumers. AI, big data, and other breakthrough digital technologies can bring clarity and scrutiny. For example, AI could help investment bankers combine and analyze large amounts of structured and unstructured data to measure environmental, social, and governance performance of a company over time, to connect actions to outcomes and incorporate the results into their evaluation. Smart people can make sure that the data that they are collected, they can train the algorithms to provide us better and better quality of results and outcomes and understanding. And also distributed ledgers and smart contracts, they could help us deploy capital more efficiently and take under consideration also the targets we have in EU into sustainable investments across assets, sectors, and borders to unlock new sources of financing, and even track information on the alignment of stakeholders and projects with our sustainable development goals. And I hope, and I think that we will discuss later how machine learning has helped us to uncover how the US market prices reacts to different climate risks, from natural disasters and global warming to international summits and national policy measures. So I think we can use digitalization also to rethink the financial system and bring it in line with our climate change goals. So at the European level, we have a strong sustainable finance strategy, and I think it's very important to increase awareness by having these discussions. So I look forward to hearing and learning more from our distinguished speakers today. And I want to thank again the organizers, our panelists, and our guests. And the floor is back to you, our great moderator, Linda Zelina. Thank you so much.
Thank you, Eva, and thank you for also highlighting the big change that we're seeing in terms of finally having some sort of political consensus that we need to figure out how to actually progress with the sustainable finance agenda and how to improve the data, because that will be an absolutely key aspect to trying and to progress in terms of the measurement of the impact of figuring out how do we actually assess whether companies and businesses and financial institutions are making any progress. We also have actually a special address from the Commissioner Mairead McGuinness today, which is very exciting. She's the Commissioner for Financial Services, Financial Stability and Capital Markets Union. The Commissioner's vision actually has been a lot focused on ensuring that the financial sector delivers for people, society, and the environment. So we are very excited to have a specially recorded message from Commissioner McGuinness. So please, if we can play that.
A very good morning, ladies and gentlemen, and a big thank you, Eva, for inviting me to be part of today's event. We were great colleagues back in the Parliament, and it's a pleasure to continue working with you now that I've moved to the Commission. I'm really glad to contribute again to a STOA event. I had the honour of being the Parliament's Vice President responsible for STOA for 2.5 years, supporting valuable work in connecting policy and science. STOA very often leads the conversation, and that's what you're doing at today's event. Of course, I'd rather be with you in person, looking at this interplay between technology and sustainable finance, but I'm very happy that technology is at least bringing us together. So here in the Commission, we have well-developed work on sustainable finance, and we have ambitious plans on digital finance. But the truth is that we're not yet advanced when it comes to connecting the two. I want to introduce some of that work to you today, but I also look forward to hearing your ideas on how to integrate the two topics. We often talk about the so-called twin transitions that are already transforming the way we live and work, the transition to climate neutrality and the digital transformation. These transitions are not separate from each other. We will need innovation and new technology to help us meet our climate goals, and the changes that they will bring together will be big. The world we see in 10 years' time, perhaps even in 5 years' time, could be very different to today's world. We need to shape the changes and not be overwhelmed by them. So, as we enter the next phase of the recovery from the pandemic, we should think about what we want Europe and the world to look like in the future. We are already feeling the negative effects of climate change. Just think of the extreme weather events that have hit communities across the globe so far this year. Floods, droughts, heat waves, and they're all becoming more common. But if we act now, we can do something about it. The European Central Bank's economy-wide climate stress test, released in September, shows us that acting early is key. Companies and banks benefit from adopting green policies early, and the advantages of taking action outweigh the initial costs over the medium to long term. This climate stress test is a prime example of how vital good data is to a successful transition. It can help us to get a sense of what to expect and inform our decision-making. But when it comes to sustainability in the financial world, a lack of clear and consistent ESG data has been a major roadblock. But thankfully this is changing. A growing number of financial institutions are making voluntary pledges on their transition plans to reach net zero, and the Commission stands ready to support them. The EU taxonomy and other sustainable finance tools provide a guide for the transition. Underpinning voluntary pledges with EU tools can strengthen the coherence, clarity and credibility of these pledges and ultimately increase their chances of success. At the international level, the EU is pushing for convergence and ambition on global work on sustainable finance, in particular through the International Platform on Sustainable Finance. So on the policy side, we are laying strong foundations. And those in the private sector are taking their role in the sustainable transition seriously. Given the urgency of the challenge, we must make sure we use every tool at our disposal to tackle climate change. And in finance, we need to look at where we can further increase our ambition. Artificial intelligence, big data, and the Internet of Things all have a role to play in the future of sustainable finance. With July's Sustainable Finance Strategy, the Commission is exploring how digital tools can help SMEs go green. And we will look at how digital tools can help investors learn about and better understand how financial products affect the environment and the climate. We are building an EU financial data space, which will include sustainability information. One goal of the financial data space is to boost the use of data for innovative technologies such as artificial intelligence. This easy access to a broad range of information will help investors make decisions about where to invest their money. And it can help businesses learn from each other on how to become more sustainable. New market entrants and established companies alike will be able to use this data to develop new products and applications that can support the green transition. For example, they can use the data to analyse and manage climate-related risks, nudge consumers towards more climate-friendly spending habits, or develop insurance products tailored to weather or climate-related events. Building links between our EU financial data space and other data spaces, including the Common European Green Deal data space and the Mobility data space, will enable users easily access and use different sets of relevant information to advance their work. The European Single Access Point, which we will propose before the end of the year, will be the first step towards this EU financial data space. It will give investors seamless access to financial and sustainability-related company information. And we're not going to stop there. By 2024, we aim to have an open finance framework in place. The revised Payment Services Directive marked an important step towards the shaping and reuse of payment account data by banks and third-party providers to build new services. Building on that experience, the aim of an open finance framework is to open up data sharing among financial institutions beyond payment accounts and banks, including insurance firms and asset managers. That will help create better, more innovative financial products. At the same time, we also want to maintain a level playing field between new and existing entrants in the financial sector. Something else we're currently working on is the EU Digital Finance Platform, a collaborative platform bringing together fintechs and supervisors, and that also makes it easier for innovative firms to test new products and applications. This will help us overcome the fragmentation that often prevents innovative financial firms from scaling up their activities. This platform could be used to see if we could support specific projects that use artificial intelligence and other digital tools to contribute to the green transition. While technology can bring important benefits to the sustainable transition, it does leave a carbon footprint. Digitalization is powered by data centres, which tend to have substantial energy needs. But we are already taking this into account in negotiations around the regulation on markets in crypto assets, which is currently being debated by Parliament and Member States. The Commission will keep working to encourage the development of and investment in low or zero emission data centres. So to conclude, the financial system is undergoing deep structural change. If we want to protect the planet for generations to come, we need to make our financial system green and ensure that finance flows to sustainable businesses and projects across the EU. On top of this, the financial world is undergoing rapid digitalisation. New products, new services, new companies, new asset classes, and almost all of it accessible online in just a click or a swipe. The Commission wants to make sure we use the digital tools at our disposal to help finance the sustainable transition of our economy. And we want to ensure that digital innovation in the financial world is part of the climate solution. There are a lot of exciting opportunities in this area. I must say I'm looking forward to seeing what comes next. So thank you for your attention, and I wish you the best for the rest of today's event.
That was a fantastic message from Commissioner McGuinness. It's great to actually see the appreciation for STOA's efforts in hosting these discussions and debates that are much necessary, and also highlighting the point that actually we need to act now before it's too late, because inaction is much, much costlier in the long run. It's also interesting to remember that we are going to see the European single access point, which will be a very important development. And it will be very interesting to see how we actually improve going forward the data space and actually figure out how to do not just self-reported data, but also use these digital tools to create more reliable and meaningful data, which is exactly what the financial sector needs and wants. So, without any further delay, we will now start our discussion, because we have some of the best experts in Europe, people who are working on these topics for many years, to share their insights and talk about how they see the developments in this space. So first up, we will have Dimitris Zafiris, who is the head of risks and financial stability at the European Insurance and Occupational Pensions Authority. He has been responsible for EIOPA's activities in the areas of financial stability, crisis management, and also research and studies. But before that, actually, it's interesting, Dimitris did have quite a long career also in the commercial banking sector. So he has seen the different sides of the equation. So we're very excited to have you with us today. And Dimitris, do we still have you with us? I think you're muted.
You do, no worries. Good morning also from my side. I hope you can hear me.
Yes, we can,
Good.
Loud and
Excellent.
clear. We can see
Excellent. So I think difficult to start after the excellent opening statements by Mrs. Kaili and the Commissioner. I will try to bring the supervisory perspective to the topic, the insurance sector perspective as well, starting from what has been done in the area of climate change, risk assessment and AI, and perhaps bringing a couple of thoughts also and some ideas of the next steps of what may be coming. So sustainable finance, climate change, AI, machine learning are among the major issues currently under discussion in the European supervisory community, and not only. Both are cross-cutting themes within EIOPA, mostly work in parallel, but of course there is this clear intention of bringing those two topics together going forward. Now, starting from climate change, we have been implementing a quite ambitious strategic plan on sustainability and climate change, including support to the Commission Sustainable Finance strategy. Of course, needless to say that the EIOPA regulation requires us to consider developments regarding to ESG, environmental, social, and governance-related factors within our framework. Several projects in this area, impact underwriting, perhaps an assessment of the NatCat formula when it comes to capital charges, or the potential treatment of exposures, assets, activities related to environmental and social objectives, use of climate scenarios in own risk assessment of institutions, our own climate risk sensitivity analysis. That's something we published at the end of 2020. It was an effort to use a top-down analysis, almost like a stress test, to assess the impact of transition scenarios on the asset side of insurers. A clear reference there, which also coincides with what the Commissioner mentioned before, that delayed policy action will have a more severe impact on the asset side of the sector. So they need to be proactive and they need to move quickly when it comes to policy measures. We will supplement this type of analysis with also bringing the attention also to physical risks, because especially for the insurance sector, it's not relevant only to look what happens on the transition side, on the asset side, but also on the liability side and the products. And of course, in comparison of ESG risks in EIOPA risk dashboard, developing stress test methodologies, consulting these methodologies with the insurance sector and other stakeholders, and trying to be very transparent about the way forward. Now, what about AI? What about artificial intelligence and machine learning? It allows, let's take a glance first of what happens in the sector, on the insurance industry. It allows companies to carry out more granular risk assessments, pricing strategies, increasingly efficient claims management process, and perhaps to fight against fraud more effectively. There are benefits there, such as prediction accuracy, automation, new products and services, and cost reductions that can be quite significant. However, ensuring fairness, non-discrimination, transparency, and perhaps what we call explainability can be challenging. There is work for the industry there, work for firms to address these challenges. As EIOPA, we did publish a report. It was at the beginning of the summer in June 2021, a report on artificial intelligence governance principles, which is very relevant to the topics I just mentioned. When it comes to applications on tackling climate-related risks, for firms, staying again on the sector, companies are slowly trying to use large data set and AI algorithms to assess business risks for climate change with better accuracy. Lessons are being learned also from other business lines, such as motor insurance. We published a review on the use of AI and ML techniques that found that approximately 55% of firms, of insurers use or applying or experimenting with the AI, ML when it comes to motor insurance, which can potentially support the development of also new climate change models, predicting or even preventing claims through the identification of successful adaptation strategies. AI could support easier, quicker claim process for customers following NatCat events. What about the supervisory community, though? What about the use of AI to identify undertakings, perhaps insurers or financial institutions with specific or similar characteristics and therefore similar exposure to climate change risk? So identify pockets of risk that supervisors could act proactively and identify and perhaps prevent an event before occurring. Now here, a very interesting question emerges. Can we use AI? Can we use machine learning to help us identify potentially vulnerable institutions? EIOPA, our institution, is currently a hub for Solvency II reporting information. This means that we are receiving the supervisory information from all European insurers. That's an excess of 2,500 entities reporting on a regular basis to European supervisors and EIOPA as a whole. There is a lot of information. Of course, these items were mentioned before, data quality issues, granularity of information is something we need to assess. Nonetheless, there is an initial data set that can be used to work with and apply such techniques. we could make use, and we are progressively making use of this wealth of data to identify potentially vulnerable undertakings, insurers. We're doing this mainly focusing so far, because this is what economists are usually used to, focusing on financial risk. But there is also a progressively the need and the intention to use such techniques also for climate change related risks. We can make use of historical observations of undertakings which are considered to be in a vulnerable state and train a machine learning model on those observations in order to predict which may become vulnerable in the future. I mentioned before, for insurance, it's not important to focus only on the asset side, on the holdings, but also the liabilities or the products, on the specific coverage that the insurance sector offers to the economy. But this doesn't come without challenges, of course. As everything new, it comes with a lot of implications for supervisors. A few examples was highlighted previously. AI depends on good data. The quality of its models and decisions will only be as good as the data that it runs on. A scientific understanding of the issues needs to lie at the bottom also of all AI applications. Scenario generation, risk analysis, good policy measures need to be based on a deep understanding of the issues. AI can support this, but cannot be seen as a silver bullet or develop into some kind of black box that it will be difficult to explain. More granular risk assessment could also potentially mean higher premiums for some. This is not a new phenomenon, of course, but AI could accelerate trends that make insurance perhaps unaffordable and available for vulnerable segments of those living in catastrophe-prone areas. This is another topic that the supervisory community, again, and not only, should pay focus on. I think with this, I should take a breath now. I think there are enough topics to discuss going forward. I'm really looking forward to hear also the rest of the interventions, and happy to take any questions on these topics. Back to you.
Thank you, Dimitris. Thank you for providing us a big picture view in terms of what supervisors and regulators are doing and what they're actually struggling with in terms of the granularity and sometimes quality of the data. Just a very quick question from what you have seen from your work. Have you seen actually a greater appetite in investing in upgrading these digital approaches and improvements in the data space? Because through our work, we actually have noticed that often a lot of different entities struggle with the price point of improving these digital systems because they're sometimes quite costly. So have you seen an appetite in investing in improving the digital systems?
You mean on the sector or from the supervisory side?
From actually both. I would be interested to hear what you're seeing. Is there appetite? Are people trying to figure out what they need to upgrade, or are they still waiting for certain technologies to mature?
There is a combination of things. Indeed, you would see for the biggest players in the market, there's a clear intention to invest. But as you can understand, the primary objective on private sector entities would be to use such techniques for efficiency gains, be it on the pricing, be it on paying claims, not necessarily making use of all information available. Information sharing, it's a topic that we should discuss, and I think it's very important to discuss. I didn't go deeply into this in my presentation due to time constraints. When it comes to the supervisory community, things are similar. There is an increasing intention and willingness to invest, but the investment there does not only, and this is a key, does not only include, of course, infrastructure and hardware, also includes people, and because something that it's not as easy to find as one may think. So finding people that they relate and they can also bring together such expertise, it's not very easy, but that's something that there is clear intention. There is this topic of what we call SupTech, using supervisory information together with technology to go and have more informed decision, more informed supervision. So clear intention there, but steps could, let's say, accelerate going forward.
Thank you, Dimitris. Very interesting. It's the human aspect that we often forget, because sometimes the best data you get is when you combine analysts with technology. Actually, talking about different partnerships, we have next up we have actually the CEO of EIT Climate Kick, Kirsten Dunlop, who has been working on this for a very, very long time. For those who don't know, EIT Climate Kick is a crucial player on the European landscape in terms of innovation. Also, Kirsten has a very interesting career where she has worked in academia, consulting, banking, insurance, and a variety of other sectors. So she has quite a holistic view of these issues. And EIT Climate Kick has been trying to figure out how to do systems change, how to innovate, and how to improve outcomes, and how to essentially trigger systematic changes that we need for improved outcomes. So we're very excited to have you with us, Kirsten. So please, if you would like to share your opinion.
Thank you very much indeed, Linda. And thank you very much to Eva and to the STOA panel for inviting me to this session and for, in fact, convening this type of conversation. So I think my number one reflections would be maybe three things that I'd like to add into this conversation. One is what are we doing? The innovations what does it mean to try to support, design, deploy innovation to catalyze systemic change? And specifically, how is that relevant to the question of digitalization and AI to accelerate the green transition? And then the third element I'll reflect on is just the relationship between that kind of work and what we describe as challenge owners, businesses, cities, regions, national governments, who are sitting with the challenge of accelerated transformation, transition, and a lot of the social, political, and economic fallout of those kinds of transitions. So first things first, we are an organization that operates through partnership, as you rightly said, Linda, and that means that we have a wide source of innovation solutions, and in the broadest possible sense, because the EIT Climate Kick from its beginnings, at the end of 2009, beginning of 2010, chose to work on the areas of climate change that are most difficult and intractable, that sit right between sectors, like some of the complex trade-offs in land use between protecting the environment, biomass, bioeconomy, climate-smart agriculture, and the needs to think about the way in which we restructure our urbanization and footprint, or urban transitions, where it's not just a question of energy substitution, but how do you change complex historical footprints and the businesses and industrial value chains, and right through to scope 3 and 4 emissions that are embedded in them, core materials and so on, and in fact the financial system. And we've been working on the core finance system for a long time. The essence of what we do is to, on the one hand, support the supply of new solutions that can be anything from new materials and new technologies through to new fiscal mechanisms or policy innovations or new business models that are much more multivalent. So they're bringing in multiple different cash flows together and multiple different dimensions of solutions. Nature-based solutions, for example, where we're literally using the reconstruction of the physical environment to act as a carbon sink, leveraging high-end technologies in wood in construction like nanocrystallization of lignin, but also leveraging design innovations in construction techniques that make it possible to build very high buildings or buildings comparable with steel and concrete high-rises that could be made out of wood. Some of the really interesting challenges around how to solve for a number of societal and economic transformation questions within the urban environment, whereas simultaneously solving for air quality, waste, water, planning, community reconnection, especially in the context of COVID, urban farming and food system security, all as one complex. And practically what that means is supporting organizations, challenge owner organizations that are usually a civic government or a regional government or a corporate, to think about innovation and use it differently. So instead of looking for a series of solutions or trying to find one or two winning solutions to invest in, working from the other direction backwards and looking at not just what we think is possible, but what is actually needed, for example, to decarbonize Europe's cities by 2030, 40, and 50. And that creates a pull space. This is the kind of European mission-led moonshot space. But what it requires is a portfolio of innovations where many different solutions are being tried simultaneously, and often competing technologies or diverse solutions connected in and applied on the ground. So this is less about developing innovation for capital markets and more about developing innovation and applying it quickly into rapid proof of concept, rapid cycle scaling, and then connection through to demand finance side. So offtake agreements, long-term structured finance that's coming through with multiple interests. Where that relates to digitalization and artificial intelligence, there are 4 things that I would want to refer to really focus on, thinking about, in our experience, technology, digital technologies are absolutely instrumental to our ability to achieve both decarbonization and adaptation, climate adaptation and resilience. And the advantage of intelligent technologies making sense themselves or responding quickly to inputs or processing a set of complexities of information inputs beyond the speed and power of the human brain is immensely important. There's a category here about the importance of raising the quality of understanding and the visibility of information. One of the front edges of innovation from our perspective is deepening our understanding of carbon footprints and of resiliency exposures to the primary level information, for example, in food or agricultural production, because very often a lot of the instruments that are being used are using secondary information that rely on reporting where we have inadequate or inconsistent data sets, or even just completely different interpretations of what is relevant. So deepening that right down to the ground, using advanced sensors and spreads and networks of sensors, but also using ground truthing with local communities and farmers to increase our depth of understanding and to broaden out our open standards so that that kind of information can be shared in compatible ways. And that's absolutely essential. Another element of this quality of understanding has to do with the extent to which we begin to understand the properties of what we're dealing with, because we actually barely understand some of the properties of the natural world and the materials we're dealing with, and begin to leverage satellite technologies and AI, for example, something like Open Surface, which is working in really helping us understand where is damage happening, where is environmental regeneration happening, how is agriculture having an effect on the land. Standardization, compatibility, interoperability, connectivity is one of the key elements where innovation can help us use information architecture and digital technologies better. The second is converting information to intelligence, because this is not just about having data, this is about knowing how to use it, and particularly importantly, understanding how to look at the implications of choices. We are structured at the moment, our world is completely structured into sectors and silos, so we're not looking at interconnections across, and starting to have open data systems that help us look at the relationships and unintended consequences of choices is helpful. That's a key element of innovation. The third is guided decision making. This is where I think some of the frontiers of digitalization and AI are really evident, where, for example, there's a possibility of recoding our attention to a civic capital economy projects that we're running, such as trees as infrastructure, that are redirecting investment efforts towards regenerative elements that are not showing up in classical investment profiles, or using multi-agent virtual technology and multi-agent virtual AI to guide decision-making on complex systems like large-scale agriculture so that we can code it for carbon capture and storage and soil carbon instead of coding it for efficiency and optimization of land, which is a lot of the degrading we're getting. And lastly, of course, real-time responsiveness in that, because we need to take decisions very fast. And the fourth and final reflection I would make is digitalization and AI is intrinsically linked to human capability. We work with MIT on a tool called Exaptive, which is using an AI to connect people's experience and capability in innovation, finance, decision-making, climate risk that is not obviously matched, but forms contiguous knowledge sets that all of a sudden allow us to see and act more holistically. So those are just some of the examples of the work that we're doing in this space, and really looking to pay attention to how do we see the system and make decisions in more systemic ways.
Thank you so much, Kirsten. I absolutely love the fact that you brought up the silos, because up until now, we've seen that there is the silo of environment, silo of carbon, but we do have biodiversity. We have also social impact that we could measure better. And since the EU is actually developing a social taxonomy, that will be a big question. And I think in most cases, we do face the twin wicked problems, which is inequality and it is climate change. And sometimes those are also intrinsically linked. So in that sense, my biggest hope is that improved technology, innovation, ecosystems, and all these different digital tools that we have will actually help us navigate the complexity a bit better and understand these interconnections and how one side of the equation affects the other a bit better. So it's great to see that EIT Climate Kick has been pushing the boundaries and thinking about what are the key systems changes that we need. Because since you're especially at COP right now, what are the most promising developments that you've seen that give you hope that maybe we will actually eventually start having some solutions? Because we've seen some criticism about COP saying that, well, you know, the ambition is just not large enough, or that we are moving too slow. So since you're there right now, joining us from Glasgow, what are your...
My reflections would be that there is a quality of determination to act at a subnational level that is very, very different, and a determination to act that is converging and connecting in all sorts of ways. People are no longer discussing if, how, who's got to do something else before they can act. They are really discussing, at least in everything that I'm kind of observing, jumping into or seeing coming across, this is a discussion on how quickly, how do we do this better, how do we unline obstacles, how do we leverage much better what we have. I think industry is also showing up in a very different way. There is a much, much more concentrated conversation, still not going far enough, in my view, still talking about climate risk, still talking about climate strategy, and not fully yet embracing the fact that climate change is simply the defining feature of all markets for the next 50 years at least. So this is not about having a climate strategy. This is about having a strategy that enables your business to be effective and to survive. But there is a much, much greater concentration of understanding and of determination in working out how to collaborate. The number one word I've heard over and over is we have to bust out of the silos, as you said, and really work out how to do radical collaborations. I think what is exposed is the extent of disconnect with the national level political process and national level, and the extent to which that is also a marker for disconnects with structures of global trade and trade finance. So there's a real energy and a sort of problem solving on the ground at subnational level of all types, including the way in which industry is looking at value chain actors. And then there is a real challenge on the multilateral international scale. But there are, I think this might be the tipping point where the opportunity, for example, to think at what happened in the wake of the financial crisis, thinking about climate risk and starting to expand that up to understand strategic risk more broadly. After the wake of the financial crisis, the Financial Stability Board introduced the notion of organizations, financial institutions that were too systemically important to fail. I think we are close enough now to being able to name value chains, economic systems, and food systems that are too systemically important not to transform, and begin to lay in place both the combination of regulation, information, and innovation that can make responses to that effective.
Thank you, Kirsten. I think that's a very interesting point, the fact that we actually have different communities really energized, and hopefully that will at some point translate into electoral and other types of pressure that drives then the political forces. Talking actually of communities of knowledge and different stakeholders, I think it's a very good moment for us to bring in Professor George Skiadopoulos, who is the Professor of Finance at the Department of Banking and Financial Management of the University of Piraeus. And he's also has a position at the School of Economics and Finance at Queen Mary University of London. So George has many hats, as you can tell. He is part of academic community, but he's also the director of the Institute of Finance and Financial Regulation. So he is looking at these these topics from an in-depth perspective. So we're very excited to have you here with us. Thank you for joining. And I believe you have a few shares. So please tell us, what is the evidence community or the financial academic community thinking about this, watching COP and having worked on these topics for a good while? Please, George, the floor is yours. And if you want to start sharing your screen so we can see your presentation.
Sure. Thank you very much, Linda, for your kind introduction. And thank you, Eva, for inviting me to this very interesting panel. And of course, many thanks to the team, and especially Marie Marcosian and Victor Aguilar. So let me share a couple of slides. I'm going to navigate you a bit in some sort of guidelines, if you wish, for policymakers based on our research, where we use AI to address a number of interesting questions for policymakers. In particular, we're going to see whether the stock market cares about climate change risks, and if it does, for what types of climate risks does it care? So this is a very timely question. I show here to you a couple of quotes from Christine Lagarde and from Tariq Fancy, the former CIO of BlackRock. So Lagarde says that climate risks are not adequately priced. And Fancy says that if I was on a panel and someone asked me what's the best way to tackle climate change, the truth is someone is better off calling their congressperson. But how do we know that these statements are true? So in particular, how do we know that climate risks are not priced? And if they are not, if there is a threat for an abrupt price correction? And how do we know that government's intervention has a role to play? These are very important questions. So to put things into perspective, as we all know, what is very important here is to dissect climate risks. And these can be dissected in two types, the so-called physical risks and the transition risks stemming from government actions and adoption of new technology. So the key question is, do stock prices incorporate, or as we call it in the finance jargon, price physical risks, or do they price government's intervention? Why is this an important question? Because if physical risks are big and they are not priced in the market, then there is a threat for financial stability, as it was the case back in 2008, when mortgage risks were not priced properly by the stock market. And if this is the case, then is there a role for government's intervention to step in and correct this stock mispricing? To answer these questions, we need to measure climate change risks, and this is not a trivial task. And here is where artificial intelligence and academic research can step in, and they can provide the answer. So in very recent work with Renato Faccini and Rastin Matain from the Central Bank of Denmark, we provide first-time scientific evidence on these questions. So we answer the question, does the stock market care about market-wide physical risks, or does it care only when the government intervenes? And which firms are the most exposed to these risks? We apply AI, in particular textual analysis, to Reuters News. So we have to deal with millions of articles here. And that's where Kristen's point on, the point whether we have a lot of data, but we need to extract some valuable information kicks in here. So we identify 4 topics. We disentangle our, 13 million articles or so in 4 topics. These are the natural disasters, the global warming, international summits, and US climate policy. We provide novel measures of climate risks. Our measures capture the attention that each topic receives by media on a given date. And what do we find? We find that investors only care about climate policy risks. They do not care about natural disasters. They do not care about global warming. They do not care about international summits. So I'm sorry, but Glasgow is not going to be in the picture. So just to get very quickly here, you see how natural disasters risks are captured by our AI technique. You see that you have spikes whenever, certain bad things are happening, like hurricanes, wildfires, flooding. These risks are not priced. At the same time, you see how our US climate policy risks look like. So you have spikes whenever certain things are happening in the US regarding the discussion on climate in the Congress. So like, when certain bills pass, or when US abandons the Paris Agreement, or when some key figures like Scott Pruitt, a notorious denialist of climate change, is appointed to the Energy Protection Agency. Here, the fluctuations signal good or bad news for the economy, depending on which party is ruling the Congress. As we expect, when the Democrats are ruling the Congress, then they're passing laws which combat climate change. But when the Republicans rule the Congress, then things are not good for climate. So we believe that these kind of results can serve as a guide for policymakers. Why? Because we find that climate risk from government intervention is the only source which is priced. And actually, interestingly, this happens post-2012. So this is in line with Tariq Fancy's claim. The most exposed firms, here we have a surprise. The most exposed firms are not polluters in general, but they are the polluters which show no intention to become greener. As we know, there are certain polluting firms which, however, are great innovators, for instance, in energy. So we should not throw, the baby with the bathwater here. We have to be careful. Physical risks from climate change are not priced. This is in line with Christine Lagarde's statement. Possible explanations for that. Maybe investors pay limited attention, and it's only the political arena which can serve as a wake-up call. Investors may be lacking information about firms' exposure to physical risks. That's why the regulation on disclosing climate risks is very important here and has an important role to play. Or investors may be simply myopic. They only care about short-term risks. They say, who knows, disasters, natural disasters pose risks which may occur, in 20, 30 years down the line, but government intervention has an actual effect because it's going to affect us financially right away. So what's the implication here? Policy intervention is required to address the market failure. There is a caveat. The recommended action holds provided physical risks are systemic. So we need to ensure that physical risks are systemic. Once we do this, our results clearly show that policy intervention has a role to play. If you're interested in this kind of research, here is the full paper and some photos of my co-authors. Thank you very much for your attention.
Thank you, George. Extremely interesting that your research actually highlights the short-termism of the investment sector, which is, I guess, the incentive structures that we have built in currently. So do you believe that this drive towards digitalization, better data, better understanding, do you think that that can change things? And do you think we need maybe more educational work to be done? Because unfortunately, in a lot of cases, these communities, as Kirsten highlighted, exist in these silos. So in your view, what could drive the change? What could actually help the financial sector to start thinking in long-termism? Do we need more policy because it seems they react to it very well? Or do we need that combined with education? Or where do you see the best pressure points for change?
These are very good questions, Linda. I think the answer to your questions is yes. So digitalization and AI can definitely help in the sense that it can help disclosing more information. For instance, we're familiar with the greenwashing effect in various firms. Through AI, we can really identify whether a firm really has a good intention regarding the environment or not. Also, AI can help us measuring climate risks more accurately. So coming to Dimitri Zafiri's points, this is also very important for risk management purposes. It's also very important to investors when it comes to constructing portfolios, because this can allow them to take climate change risks into account in the portfolio construction process. And of course, we need more education. And of course, policymakers have an important role to play. My experience, at least, is that in many cases, people simply try to tick the boxes. They simply try to tick the boxes without really taking measures, real measures to tackle this climate risk. That's why also in our research, we find that international summits are not priced. We believe that this serves mostly like a marketing tool, if you wish. Any decisions which are taken there you know, if they ever come into legislation, they take awfully a lot of time to get into legislation. So I think AI can definitely help here. Academic research can help, and of course there is a long way to go. Thank you.
Thank you, George. I think it's very encouraging to see that actually in terms of academia, we have more and more PhDs and more academic community around climate change and climate risk and impact measurements. So, I mean, it's still relatively early days. So let's see how this space speeds up and heats up at the same time. And hopefully we will have better experts going forward. But thank you so much also actually bringing up risk, because we do have somebody who is very well positioned to tell us about what's happening in the risk management space. With us today, we have Tayfeine Beauperrin from the Federation of European Risk Management Associations. So this association has a very good understanding of how risk is looked at the moment and how it's also changing in relation to all these policy developments and demands from the market. Tayfeine actually has also done a lot of work for Euro Chambers in the past. So that's the Association of European Chambers of Commerce and Industry. So she has seen different sides of these different sectors. So we're very excited to have you with us today. So please, Tayfeine, if you want to come in now and tell your...
Thank you, Linda, and thank you to MEP Eva Kaili and her office for the invitation to speak, as well as the EU40 and STOA for hosting the event. So, as it had been said, the topic of climate risk could not be timelier than during the COP26, and this AI and new technologies angle is well spot on and appreciated. So, but before starting, I'd like to say a couple of words about the risk managers, basically, who are the professionals responsible for taking an enterprise-wide views of the risk and the opportunities for the organizations. And to do this, they rely on the framework of identifying, assessing, mitigating, transferring risk, and then data is key in this respect. So coming to the topic of today, I wanted to lead with a statement. Companies must be, first of all, more resilient, and we need a public-private partnership to help for the recovery. So from a risk management perspective, climate change is not a new risk to us. What is different, though, is the frequency and the impact of extreme weather events, which are both increasing, and so are the losses. So it has already been said, you've seen over the summer, you know, the flood, the fires in Europe, hot weather in Canada, Hurricane Ida in Louisiana. And when you really look at the losses, you can see that in Europe, the flood losses were between 5 to 6.5 billion euro, but these were only the insured losses. So we do not know the uninsured losses. And so in fact, the risk managers, what they do, they focus more on how to be resilient. The discussion is no longer about how to manage risk, like climate risk, for instance, but it's how companies can be more resilient in the face of a number of interconnected risks. Because with globalization, with digitalization, the risks are now all interconnected. Another part of the picture is that we are seeing some insurers saying that certain risks are uninsurable. This is worrying for businesses because insurance plays a very key role in ensuring their financial resilience. So the word uninsurable is especially worrying considering what happened to many businesses over the pandemic, and they were left with really no coverage for the business interruption losses they incurred. So this is why at FEMA, we do believe that we need to set up a European catastrophe risk framework based on a public-private partnership to foster resilience for our economies. And that would help businesses bounce back after the loss event that had taken place. And this is particularly relevant for climate risk because this could be the next pandemic. So we need to anticipate, acting early, as Commissioner McGuinness said. And when looking at what we can do to prepare for that, we need to be able to assess the potential risk and the possible impact and data is really key here. So moving to data, in November 2019, FEMA authored a thought paper on the implication of AI for risk management. And at a very high level, it won't surprise you, but what we found is in order to perform well, and it has been said by Dimitris, AI needs data of a certain quantity and quality. So the very first question to consider is therefore the organization's strategy for managing corporate data, its own corporate data. And this required considerable investment to improve their resilience, notably to climate risk. So companies on one side need to do their own work internally, but there is also massive potential in data sharing in the EU. And that's why we're extremely supportive of the European data strategy, and in particular, the future initiatives that Commissioner McGuinness spoke about in the area of open finance and notably open insurance. And we also very welcome EIOPA's consultation on open insurance, which is definitely a step in the right direction. Still, we are disappointed that at this stage, there's no specific reference to companies in the discussion paper, where there is a lot of potential in this area in terms of innovation and improving the organizational resilience of companies.
Okay, fantastic, Taifein. I love the fact that you are reframing partially the discussion from risk to resilience, because it's true, knowing the risks is one part, but actually building that resilience and using, as one of the first speakers said this, actually, I think it was Kirsten, actually, how do you use that information to that's very, very interesting. So on that note, actually, how have you seen the AI impacting the risk manager's role? How have you seen these developments playing out in day-to-day practice for risk managers?
Yeah, so basically risk managers, they need to understand the new risk and the exposures of the organization related to new technologies overall, as well as all the opportunities, of course. So on the one hand, this means that risk managers, they must look at how AI will impact their company's risk profile. For example, the liability concerns. On the other hand, risk managers do also look at how AI can make them more efficient in their own role, in assessing risk and opportunities, assessing the exposure of their company. So on this point, it's clear, however, that we are at the beginning of the journey. We conducted a survey in 2020 where we found out that 10% of risk managers are making regular use of AI in their role, and a quarter of the risk managers regularly use some form of process automation in their role. But as I said before, this all depends on access to good and reliable data, which is still held in silos, as also we've discussed before, and are not available to be used. So for example, there is a huge potential in accessing historical loss and claims data on climate-related risk, which could help risk managers conduct their own risk assessment more accurately, advance their predictive capabilities, and even to respond faster. So this ultimately would definitely help foster more corporate resilience.
Thank you, Taifein. I think that's very interesting in itself when you actually tell us the numbers of actually how small the part of professionals is that uses the data on a day-to-day basis. And it's going to be interesting to see how that changes. We did a big project with Refinitiv and PRI this year, actually, on looking at the data gaps. In this case, we looked at the social impact indicators. So rather than effort, how do you actually measure whether this effort is translating into real impact on the ground? Are these policies playing out? And that was very interesting to see how many gaps we still have, but also how much we already have and how much is not getting used. And I think that going forward will be a big development in terms of all these data points that exist outside the self-reporting space, and that you can very easily actually aggregate with the new digital tools. So I think we're going to revisit these points and see also what our other speakers think about these. But because we are running short on time, let's just move on. With us, we also have MEP Mikuláš Peksa joining us today. Interestingly enough, I think it's a notable fact that Mikuláš is a biophysicist by trade, well, by training, and now he is sitting in the European Parliament and being part of a lot of these very interesting, intense discussions about what next, what the EU should do in the space of sustainability. So we're very glad to have you at this EU40 and STOA event. Mikuláš, would you like to come in and reflect on what we've heard this far? And we can't hear you, so I think we might have a small audio issue. So let's see if we can fix that, please. Let's try again, Mikuláš. No, we still cannot hear you, unfortunately. While we're trying to fix that, if our technical team can please look into this. If Kirsten wants to actually come in now, because I think she has actually been working on managing risk in insurance and has touched upon this work. So please, Kirsten, if you'd like to come in now while we're waiting until
Thank you, Linda. I was just, it was a build on Tefen's reflection. Thank you very much. It's really important building in the picture we're building. I think one thing that I would add is for any business, and it becomes very evident when you're starting to work into the heart of insurance. I've spent a long time working in the north and the south of the global world in insurance. And it's very interesting when you're working in the southern hemisphere where insurers repair. So they're the biggest home repairers and motor repairers in the country, and you start to really see the depth of supply chains and how to reduce underlying risk. But I think one of the critical things in what we're discussing is to expand what we're describing as climate risk, because there is the physical risk, of course, and the extent to which that is increasingly more volatile and unpredictable. And there's transition risk in terms of the impact of regulatory change and the impact and costs of transitioning whole business models and value chains and supply chains. But there's also the risks associated with the societal license to operate. And there are significant risks associated with the ability of organizations to pivot and to let go of existing successful business models and operate in a world where the business context is no longer a steady state predictable environment, nor is the financial context on any level of the business itself. And that is another, in fact, if anything, one of the critical pieces of what I would describe as the strategic risk associated with climate. How easy is it for businesses to reinvent and to access innovations, for example, to help them transform the core business model that is not diversification in startups, but really the embedding of very, very different assumptions about how we define value, how we think of economic structures, how we think of public-private value creation, how we bring in blended finance, and how we change kind of core materials or assumptions about demand, consumption, and so on. So I think it is also really critical. And then for insurers, for example, in my experience working with large insurers, to introduce and subsidize or pay for technologies like four-dimensional printing, where the properties of the material will change themselves if you print them in molecularly, to reduce the underlying risk, so that because as soon as we increase what is already happening in parts of the world like Australia or North America, where significant parts of retail insurance are already unaffordable and commercial insurance increasingly become so, then we have the problem of all of that risk falling back on the states, and the state being the insurer of last resort. So we really have to completely redesign our notion of handling risk in the system and turning it into a driver of accelerated investment in the innovations that restructure the way we're doing things. But it is, of course, as we're saying, a problem of joining together worlds that don't necessarily currently act together and leveraging what we can in the way we're using information architecture to enable that.
Fantastic. Thank you, Kirsten. The information architecture indeed. I think that's a very good point to bring up in terms of how to use it, how to understand it as well is absolutely key. I believe Dimitris wants to jump in here because he has a quick reaction to what's been said. Then we're going to go back to you, Taifein, and then we're going to try Mikolash one more time. Okay, so please.
And again, perhaps building a bit to what Taifein and Kirsten mentioned before, but Taifein, when you mentioned the insurability or lack of insurability, because indeed, as climate change deteriorates, more events, prices may increase, premiums may increase, and there may be a point that some risks are not then insurable. But that's moving into the more extreme events, maybe moving into the medium or long-term future. But what about today? Because today we do have a protection gap. So it's not like today, let's say all risks are insured and the population is covered, because indeed today we do have big part of Europe with significant risks not being covered. We do have this discussion of what can be done, what policy measures can be taken in order to limit to the extent possible the protection gap. And this is something that I think, again, what you mentioned, the public-private sector cooperation, but also some measures can be taken. Perhaps we should also see it at the European level, because there could be European solutions for something like that to limit the impact of the protection gap as it even currently stands.
Thank you, Dimitris. Very interesting, bringing our attention to the protection gap, because I guess we already have seen certain reactions from the market where insurers don't really want to insure something that they know is very, very high risk or has had precedents of destruction of value. Taifein, please, you had your hand up, so if you'd like.
Yes, I wanted to react to both Kirsten and Dimitris. So to Kirsten, really the point of I think what is important is to be able to support companies who are in this transition, in the business model transitioning. And here we do see a lot of risk managers telling us that their companies are investing a lot. And it is not factoring when they buy insurance product, for instance. So I would say investors, insurers should take into account all the investment which is being done towards this transition, because it cannot be done in one day, of course. And there's probably something here to reflect upon how it could be factoring to support, to give these incentives that is needed for companies to really do it. And coming to your point, Dimitris, of course, yes, the protection gap is very close to our heart as well. Definitely, probably for some, where in areas where there is a lack of coverage, probably there is a need to raise awareness also. Sometimes it's very complex. The insurance products are very complex, but overall, this insurance gap for more the systemic risk, we definitely see that the only way, because we need some solutions, because it has been a pandemic. Tomorrow, it could be climate change related risk or a big cyber event. So we need a solution. It can only be a public-private partnership. We can make it happen. We can not just say, okay, we'll leave again the governments to invest massive funds. No, we need to be able to find a solution. And I fully agree with you. Probably there is a level where the EU could do something so that we coordinate their action across the EU, because it impacts the whole single market. So all countries are impacted.
Fantastic. Thank you, Taifein. I think it's an interesting question about public-private partnerships. We have been trying them for a long, long time. And I would really like to see a more solid reassessment of what has worked and hasn't worked, so that we can rethink that model. And with what Kirsten has been bringing up, we do really need to figure out how to do it in a more systemic way and how to see more systemic change in this space, because we keep tweaking at different parts of the system. And I think that we're still failing to think in a fully systemic way. And hopefully that technology will help us navigate that. On that note, let's try again with Mikolash. Can we please try if we can hear you? Please,
I'm trying,
Mikolash?
if you can hear me.
Yes, we can hear you. Perfect.
Wonderful.
You're with
Wonderful.
us.
Thank you very much. Thank you very much for inviting me and for having the patience for my technical problems. I mean, like, also thanks for mentioning my professional background. It's true that I'm a biophysicist, and then I somehow moved to the IT. So to say, combining those two worlds of sustainability and digital altogether. I mean, like, those are two most important technological or industrial revolutions of our time. And I think they are kind of complementary because they help each other in achieving each other's goals. And there is one general approach that more or less overlaps as an umbrella those two terms, and that's the decentralization. We do strive for decentralization of energy production. We do strive for decentralization of digital networks, and this is very much an approach that frames this whole revolution and gives it the new quantity, the new opportunities that we as mankind can use and utilize. And so far we did. But there is still definitely a lot of space for further development, where what we can use and where we can expand. So I was really happy to have this opportunity to follow the discussion, because the speakers contributed quite a lot in various directions about what are the options we have in front of us, and we just need to use, and that needs really a proactive approach. So I was happy for having this opportunity to be here to talk, and also I hope that all the followers of this stream use that as well, and will take the contribution that was provided. Thank you very much.
Thank you, Mikolas. I do have one more question for you, since we've just brought you in and you sit in Brussels and you're part of the European Parliament's work on all these issues. So actually our center, the IFFR, or International Sustainable Finance Center, very long name, is actually headquartered in Prague. So we share some of the same spaces, I guess. And I was wondering, in terms of the next 5 years in Europe, what do you see as the kind of crucial changes that we can expect? We know that there's social taxonomy coming. We know there's European single access point. Do you also think that we need maybe better climate or European Green Deal diplomacy, since we have Czech presidency coming up next year? I wonder what your view is on trying to actually align all the European countries with much more similar messaging on what Europe is doing, because of course, whoever sets the standards exerts quite a lot of influence. So I'm just wondering what your take on that would be. Do you see Europe playing a bigger role? Do you see some sort of global alignment?
I see that as an absolutely necessary step forward, because we, of course, had the Paris Climate Agreement. However, now the question of implementation comes, and just a simple look on the map shows that Europe is currently leading the whole effort. There are others putting some effort, but we are the let's say most progressive. And in that sense, we definitely need the others to align with us, because otherwise the whole effort would probably fail. So there is definitely much more needed to be done in order to actually reach the goals. With mentioning the Czech presidency, I know that you probably know that you have touched a sensitive point for each and every Czech, because it's true that the leaving government of our beloved Prime Minister Andrej Babiš was kind of critical towards the European effort for climate neutrality. However, the new government that is now being formed, and whose coalition agreement was already signed, considers the climate to be an important topic, and the sustainability is supposed to be promoted. So I believe we will be able to manage through this upcoming Czech presidency in the second half of the next year to really move the whole agenda forward and bring more sustainability also into our foreign diplomacy. I mean, foreign of besides Europe. I mean, like, I don't consider the diplomacy within Europe to be foreign affairs.
Thank you, Mikuláš. Yes, I mean, it's very exciting to see a political change. So let's see what the Czech presidency brings. We have a lot of high hopes for it, of course. I think it's very interesting also talking about transitions. We have a question from one of the participants. Samuel Zilber asked how to measure intention to become greener, and our transition scoring and rating, could that be useful? And that's very interesting because recently, I don't know how many of our listeners have noticed that we actually have a transition pathways initiative that sits in London, in Grantham Institute. We also have some other, I think, new initiatives springing up, I think, next year, funded by philanthropy. So we will see a lot of development because, especially in Central Eastern Europe, the transition, I guess, will be even bigger. And we are starting from a slightly different starting point. So it's going to be a big conversation. How do you measure these transitions? And I think Kirsten already has her hand up. So please, Kirsten, if you want to come in. And then we have George as well. Kirsten.
Okay, the connection just dropped. Can you hear me now? Yeah. Just one thing to add into that, actually, in a very uniquely and importantly European, the missions that now begin and the Green Deal pilot initiatives are a form of strong transition signal. So the Net Zero Cities initiative that is beginning now, which is the beginning, the pilot of the cities mission and the roll through, envisages 100 cities in Europe signing a climate city contract to commit to decarbonization by 2030. Now that creates a very strong signal around the intention, and the intention earmarked to a time frame that we know is a massive stretch goal. But in terms of the aggregation effect of 100 European cities, all of whom are serviced by European SMEs and industry, value chains, supply chains, they have a really important market signal in terms of that intention. And this will be an initiative that pilots the sustainable finance taxonomy. So there are opportunities for a number of things to come together, just as a sort of less financial world, but possibly one that the financial world then really can start to take greater confidence from.
Thank you, Kirsten. A very good point. George, would you like to add something? I will start talking a lot less because we're running out of time. So please, if anybody else wants to come in, just pop your hand up, or pop your hand up also physically. I can see you.
Thanks, Linda. This is a very good question, actually, and I think it relates to the sequel question about what source of data to use to identify biggest polluters. So in finance, things are a bit more complex. Of course, there are firms or institutional investors who sign up in various associations like PRI or others, but real intentions may differ from what people claim that they wish to do so. So one measure one typically uses is the E ratings, so a pillar of the so-called ESG ratings. But we know nowadays that we have various problems there. For instance, the ESG ratings provided by different providers may differ a lot. So in fact, the correlation between, in the E pillar or in general in the ESG ratings across different data providers is about 0.5, whereas if you contrast this to credit ratings provided by different providers is above 0.95. So this divergence of E ratings creates a confusion to investors and also to various analysts. So AI also has a role to play here because it provides alternative ways of measuring intentions. So for instance, recent approaches involve, go to the 10K filings in US and analyze the 10K filings through textual analysis to identify the real intentions, or even going to conference calls between CEOs or board members of the various firms where you can identify the real intentions. So I think, again, this is a role for AI to play because you can identify the real intentions rather than relying, on some measures which may be imperfect. Thank you.
Thank you, George. It's actually a very interesting point. ESG correlation and the noise in that space, aggregate confusion, they call it. I think it's a very interesting point that, having worked with investors for over 10 years, actually quite a lot of them were very excited by the point that there was no correlation, because that meant that if you could dig out who, like, the best data or the best performers under the E, while everybody else was looking at the wrong rating, that was a great opportunity. So for me, it would be very exciting to see how these different data providers potentially and hopefully would then get driven by the competitive advantage if you can actually prove that your data is better than somebody else's. And this is something that we've been trying to work on in terms of how does technology actually provide them some sort of competitive advantage if you can actually have a much more meaningful data that helps you predict how these companies are going to perform. Right, we've got 5 minutes left. So would there be some quick concluding remarks that we could have from Dimitris, Tayfein, and everybody? Maybe the kind of 30-second pitch in terms of what do you expect going forward, and what would be your kind of concluding big message to our watchers and listeners, please. I think we go Tayfein first, then Dimitris, then George, then Kirsten.
So basically, in terms of my concluding remarks, I would say that, we've said, the clock of climate change flies fast. It's time for action implementation, and climate change risk assessment must be a top priority, definitely. New technologies can really be a great facilitator. That's why all the initiatives of that, the European Single Access Point, open finance, open insurance are extremely useful, but the data needs to be used also by the companies who are providing the data. So we need to ensure that. And last point that I'd like to stress is that climate risk is not a risk that can be considered in isolation, neither the related technology. All this should be seen really within the bigger picture, the interdependencies. And we have to avoid that by focusing only on climate risk, we will lose sight of the other major risks and opportunities.
Thank you, Tayfein, about the blind spot with the climate risk. Please, Dimitris.
Perhaps not concluding, but adding, it's the topic of impact underwriting and potential links of impact underwriting to AI. Impact underwriting promoting a risk-based approach to climate-related adaptation measures in insurance products. With other words, adaptation measures that they are implemented before a loss occurs, and it can actually reduce the physical risk exposure of the policyholder and the insured losses for insurers and the society, of course, as a whole. This is a key tool to maintain the availability and affordability of non-life insurance products in the future. And I'm sure that this is another area that AI, machine learning, and making use of data and information can be added here.
Thank you, Dimitris. A very good point. Kirsten, you next.
I think I would, just two things. One, to answer explicitly the question around the source of data to identify polluters. Actually, there's a whole constellation of AI-based organizations, starting with Carbon Tracker, that are now using satellite imagery and AI to literally track emissions from every single point and put it together off the ground. So there are now, and it's an open data system, so there start to be global sources. My reflection would be, if we're really asking ourselves about how the financial system accounts for climate risk and leverages digital technologies, there is a real opportunity here to reverse the paradigm. How do we account for the risk of not acting, and then locate the risk and the cost of acting in that delta? Because we are continuously talking about pricing the single risks or talking about pricing the costs of transition, but sometimes we forget to put it in the context of the cost of inaction. I do wish to carry in from COP the conversation last night with the government of Scotland and the city of Glasgow, and some of the reports that are coming through on housing valuations once you start to price in climate risk. And where you can see that the really significant problem is the social risk of dropping that in immediately, because it immediately catalyzes instant negative equity. And all of a sudden, then you've got a massive social transition risk. So how do we help the financial system to account for and think about leveraging a transition through also in terms of societal just transition impacts?
Thank you very much. Indeed, finance does operate in society, and society does impact also financial risk. George, very quick few seconds, and then Mikolas.
Sure, thanks. So our research shows that investors do not pay attention to natural disasters. They pay no attention to international summits. They do pay attention to government intervention. And I would like to add to Tai-Feng's comment, climate risks are not the only type of risks, as Tai-Feng correctly said. And that's why we also are bringing up the caveat. Our research shows that government's intervention is going to correct mispricing, assuming that these climate risks are systemic. So we need to pay attention that the climate risks are systemic. Otherwise, we may be hurting companies which are innovating. They may be seemingly polluting, but they're innovating and transitioning to a new state. So we need to be very careful there. And at a firm level, as correctly also pointed out by Kirsten, E is just a pillar of the ESG triplet. So it's also very important to have good governance. It's also very important to have a good social dimension. Otherwise, without good governance, for instance, climate is not going to work. Thanks a lot.
Thank you, George. And thank you, EU40 and STOA, for hosting us. We will give Mikolas now the very closing remarks.
Thank you very much for the word. I mean, like this was really interesting discussion about how to create more sustainable economy, and I believe this type of discussion shall be held much more often, because not only on the European level, but we do need it for on all the levels, for the national, regional, on municipal level, because the real change starts by every single man or women, by the participation of each of us. So hope to meet you next time for those discussions, and we will move the sustainability forward together.
Thank you very much, Mikolas. And it's a good reminder for all of us that essentially every single one of us has some responsibility and a role to play. So it's not somebody else's job to try and improve the situation. I think every piece of the puzzle needs to play its part, and everybody needs to keep in mind that fighting climate change and inequality, let's put it that way, is not somebody else's job. We can each contribute through our current roles, whether we're in finance, banking, risk management, whatever it is. Keeping that in mind, keeping it a bit less abstract, is a great idea. Thank you so much, everybody, for joining us. The event has also been recorded. The video will be available for rewatching and sharing later. Thank you, everybody, for great contributions and interventions. Thank you, EU40 and STOA, for hosting us, and MEP Eva Kaili. Thanks, everybody. And yes, let's keep the good work up and hope that post-COP we will see some very positive changes on the ground.